Hello everyone. So I welcome you again to another session on our value investing series. Again, this topic is going to be very interesting. Let's directly get into the topic. Which mutual fund to SIP? So these days, many people are interested in going through a mutual fund way of investing in the equity market and even in the bond market. Well, in that case, even in the commodity market, since the stock market is so much fluctuating and people think, or the common investors think, that investing through stocks are very risky, so they have opted the way of investing through mutual funds. So mutual funds, as you know, these are pools of funds, a number of stocks, bonds, gold, other commodities, cash, all these things are incorporated and pooled into a fund, and these are named as mutual funds. So there are a lot of mutual funds available in the market by various AMCs like Axis Mutual Fund, Mira Asset Mutual Fund, DSP BlackRock, then you have Con Funds, then you have ICICI Prudential Mutual Fund, Tata Mutual Fund. So there are a number of AMCs providing mutual funds. So now the confusion here is that the investors are too much confused on which mutual fund to SIP. So systematic investment plan, SIP, as you know, is utilized by various investors to stagger their investments over the years, and as soon as they get the salary, a part of it is invested into such mutual funds. So say somebody gets 1 lakh salary, I would ideally recommend him to at least invest 20 to 25% of his salary, which is like 25,000, into mutual funds. So which mutual fund should you opt for an SIP? So first of all, I would say you should opt for the best mutual fund. So what is a best mutual fund? So I would say a best mutual fund is a fund which has fallen less in a falling market or in a bear market and has given substantially upside in a bull market. So you should have a stable return. You should not have a high beta value. Beta in the sense, if the market goes up, it goes along with that in the same ratio. So if the ratio varies, like if the beta is less, it means that even though market fluctuates much, the fluctuation in this fund is less. So if you go with too much conservative beta, then it will be a very nominal return. So you should take some risk as well, but you should find a balance wherein you find out a fund wherein it has performed well in a bull market and has not fallen much in a bear market. So that is a definition or a prima facie definition for a best mutual fund. So these days, unlike olden times, we have got a number of apps, we have got a number of websites wherein you can go search for the mutual funds, filter it out, screen, and put your own screens to understand which is the best mutual fund. You can see the past performance, you can see the anticipated performance of the mutual fund, and you can opt a mutual fund. So I prefer websites like Value Research, wherein they have given detailed analysis or detailed snippet of the entire mutual fund, its portfolio. So if you see other apps wherein many of the apps doesn't show the portfolio holdings of the mutual fund, but wherein in Value Research you can see the entire portfolio holdings of that particular mutual fund. Portfolio holdings in the sense, as I told, mutual fund is a pool of various investments. So after choosing a fund, once you go to the portfolio session in the Value Research, you can find the mixture of or the percentage allocation of stocks to bonds to cash to gold, etc. And again, under the equity portfolio, you can see which stocks are being held by the fund house and which funds are decreased in percentage in that fund, then how much is increased. So all those allocations and changes in allocations also can be easily monitored through such websites. Even you can see money control, but Value Research is much superior as far as monitoring a mutual fund is concerned or analyzing a mutual fund is concerned. So in the below comment box, I'll pin the comment wherein I will list out all these websites or links, and you can use that link to install or go to that website if in case you are not aware of that. Once you go to the portfolio of the mutual fund, you should see the top 10 holdings, because mainly the top 10 holdings will have the largest allocation of the funds being received in the mutual fund, and hence the highest portfolio allocation are those stocks or those components or investments in the mutual fund which will decide the way forward or the returns in that fund. So if you see, you go to a mutual fund, say Axis Blue Chip Fund or SBI Blue Chip Fund. So in that fund, if you go to the portfolio session, then you can see there are stocks like TCS, blue chip stocks like TCS, Hindalco, Grasim Industries, etc. So just to give, I'm just taking an example. So in that case, you know that say 9% is held in Reliance, say 9% is held in TCS. So if the IT index or the IT companies are not performing, then that mutual fund performance can also be impacted. End of the day, you need not see the performance of the mutual fund every day. It has to be in a longer run, because there is a diversified portfolio in every mutual fund. That is why somebody is going for a mutual fund rather than going for stocks which are having a risk of concentration. So risk of concentration in the sense, in the mutual fund you have got 10, 15, 30 or to up to 30, 35 stocks as well. But if you go for buying a single stock, say TCS, with the entire amount or in a lump sum buy, then you may not be able to diversify your investments, and maybe you will be stuck up in that investment if the particular bet goes down. So if you are entering at the right price in the stock, then nothing to worry. But unfortunately, majority of the people enter the stock at a wrong price, then the returns can be very much impacted. Unlike a mutual fund wherein there will be up and down in various stocks, so end of the day, the averaging effect will happen as far as you keep engaging your SIPs on a monthly basis. So once you go into the stock portfolio, say in the equity session of the portfolio, then you can see the individual stock performance. If the top 10 stocks are very well performing, then you can see the fund is also performing, and vice versa. Also, you can see the comparative performance. That is, you can see the comparison of that particular mutual fund over the years with respect to the index, say Nifty or Sensex. So in that case, if the Nifty has underperformed to this mutual fund, then the fund manager has been successful to build a proper good portfolio which is beating the index returns. So that is one important thing. So it is to be ensured that the fund is beating the index. Otherwise, you can simply go with an index fund wherein the expense ratios are also less. At the end of the day, what you have to see is that if you take a period of 5 years, and if you evaluate the performance of the mutual fund over the 5 years, then at least out of the 5 years, 3 years, this fund should overperform or outperform the index, and say 1 year it can underperform, and another year out of the 5 years it can be of a equal performance as that of the index. So if such a thing is there, then I have seen that the particular mutual fund you have selected is safe, and you need not keep switching the funds. You can continue with that fund, and it will help you compound your wealth over a period of time. So you can see the historical performance, the fund performance, etc. So you should also know that the past performance need not be the futuristic performance or the projection of the futuristic performance of that stock. You should actually see the fund manager's performance and how the fund manager has handled the funds or other funds, so that if the fund manager is smart enough, then he will really help you generate enormous profit. As I always say, you should always go for a direct fund, that to a growth plan. So direct fund since 2013 is been introduced. So till 2013 there were only regular plans wherein every time you do an SIP, there is an extra amount which is going as a brokerage to the brokerage firm. So for example, if you want to invest in Axis mid cap fund, so you can go log into the Axis AMC website, like you can Google Axis mutual fund, then go inside, then register your PAN details and name and mobile number, email, etc. And you can log in there, and you can easily do your KYC. This all happens in a day, then or within hours. Then you can go link your bank account to that mutual fund, and then you can buy the required mutual funds on a systematic investment plan basis, or maybe on a lump sum basis. So such direct investments through that AMC is direct funds. So if you have a ICICI direct account, Demat account, or any other Demat account, say of Kotak, then if you buy a mutual fund through that, then you have to go for regular fund. So there the NAV you pay would be higher, in the sense, so you have to pay more for the same holding of mutual fund. So to state an example, say you are investing 10,000 rupees every month for say 20 years, and say you are expecting a minimal returns of say 12%. So in a regular fund, over the period, 1% is the difference in NAV between both the funds. So that is like a brokerage to the agent. So 1% over a period of 20 years with a 10,000 rupees SIP will be a large amount. So the SIP, whatever you are doing, has a annual return of 12%. Then in that other case where there is a regular fund, then the returns is say 11% because of the higher NAV. Then you are losing 1%. So this 12% compounded at the end of 20th year would be 1 crore. But in the case of 11% case where there is a regular fund, then the returns or the end of the year, end of the 20th year, the amount will be 91 lakhs. So the difference is 9 lakhs. So I agree that over a period of 20 years, 9 lakhs is not that big, but still, why to lose 9 lakhs? 9 lakhs would have been a fairly good enough thing, even at that time, for you to buy or for you to cater to any other needs. So, just for selecting the fund, you need not keep on paying the agent of over years. I would say do your own research, select a good mutual fund. There are a number of apps which I am sharing here. So you utilize those apps, those free apps and free websites. Do your own due diligence and go for good funds and keep monitoring your funds every 1 year to 1.5 years. So that if something is happening or some fund managers have changed or your returns are subdued, then you can think of switching the funds and going for new funds, but you need not go for the regular fund. Also, why I recommended growth funds is because if you opt out for dividend payout funds, so this whatever dividend is coming into this stock holdings of the mutual fund, you will directly get it as a payout with applicable taxes. So in the case of the growth plan, the amount whatever is received as the dividend will be reinvested into that mutual fund, and this will help grow the returns because it will have a compounding effect, because more amount is going into that which is generated from that business itself, and it will again be reinvested without taking extra money from you, and that will again grow over the period and it will compound itself. Also, I am seeing that if the market is going down, people are stopping the mutual funds, SIPs, then selling it off, buying some stocks. So this is a wrong way of investing. If the market goes down, it is good, your NAV also goes down. So in the next SIP day, you will get more number of units because the value of the entire portfolio or the NAV of that particular mutual fund has gone down. So for the same, say 5,000 rupees monthly, you are doing a SIP in say one fund, then for 5,000 rupees, you will get more units because the NAV has gone down. And then again, once the market goes up, the NAV increases and you get the returns. So as per me, don't try to judge or time the market. Stay with the market, stay invested, and don't take drastic decisions of selling or switching the mutual funds unnecessarily, which will actually impact your actual portfolio return. So the mutual fund SIPs has got three main advantages. One is rupee cost averaging, which I already told that if you are buying, say, in this month, the mutual fund NAV is 10, then if the market goes down, then you get it at say 8 in the next month. So average out, you are buying it at 9. So you are doing an average. It's like once the stock goes down, then you are bullish about the stock, and if its fundamental is good, then you invest it at a lower point. Then again, once the market goes high, then you have a averaging in place. So similarly, this mutual funds helps you do a rupee cost averaging. Also, it brings in discipline to you. So whatever happens on May 1st or April 1st or whatever the first day of the month, you will be investing, and automatically the deduction will happen from your account and it will go and get invested in the market. So why this SIP in the automated mode is because if you are having that freedom of investing, whether now I'll invest, next month I will not invest, so you will be trying to time the market and this will not fetch you real returns. So this helps you become a disciplined investor. Also, it has got a good flexibility, like you can stop the SIP, you can pause the SIP, you can switch the SIP. So all these things are available in the current scenario for the mutual fund portfolio. So this gives you a good flexibility of handling your investments. So never try to chase the top performers. So I have always seen that top performance, like top 1 to 10 or maybe 1 to 5 performers, always keep switching every year. So this time if it is Cond, then next year it is Axis, then the next year it becomes Mira Asset. So it keeps switching. So I would say for a consistent compounding, go for a consistent return funds. So I would say ranking from say 8 to 15. So in that range, if you select a fund, I've seen in my own experience that whatever mutual funds I'm doing as an SIP, so I'm not bothered about every year's return. So you need to have an average CAGR of say more than 15% year on year. That's what you should target. You should not target 25%, 30% return. So maybe a fund can give some that high returns in a year, but it cannot have a consistent return like that every year. So don't chase such funds. Stay invested in your own fund. the stocks or the other portfolio which the fund manager is handling in your portfolio will go up someday as the time comes. And the market, as I always tell, is not in a straight line. It has its own up and down, so it will take its own time to reach the peak. So you just have to stay invested and do a systematic investment plan in a disciplined way. Regarding the number of funds, I would say you should have 4 to 6 funds as SIP in your mutual fund portfolio. You can have one large cap, one mid cap, one small cap. If you want a flexi cap or a multi cap fund, then you can go with an international fund. So this is enough. Now, like fund houses like Axis Mutual Fund is coming up with multi-asset allocation. It was earlier called Axis Triple Fund. So such funds are there wherein they are diversifying into equity, then debt, then bonds, then into gold as well. So bringing in gold will actually flatten the returns. Still, it will sail through inflationary environment like this and give you a stable return. But the returns are so conservative or so subdued. So you have to see which type of mutual fund you are opting and what type of an investor you are, what age you are in. So if you are young, you can go with more aggressive plans, allocating more into small caps and mid caps, and wherein the growth is very aggressive and also the volatility is very high. But as you grow older, as your risk appetite reduces, and you should actually reduce your risk appetite because your income is reducing, you may not get salary in your old age. So at that time, you have to switch into conservative or debt-based funds with lesser allocation into equity. If you are a beginner in the mutual fund, then you can consider going with a single mutual fund. Then as you get a grip over that, then you can increase the number of mutual funds to 4 to 6 numbers. And also, I will not suggest you to go with 500 rupees because the mutual fund can be as low as 500 rupees as an SIP. So don't go with 500 rupees like that. Go with some decent amount like 2000, 3000 rupees or even more than that. So if you are getting a good salary, then minimum should be 5000 in one SIP. Because as Warren Buffett says, it is better not to invest if you are investing a small sum. Like if you invest a small sum, your returns would be very less. Even if your portfolio increased by 100%, if you have invested just 1000 rupees, so what you get is 2000 rupees. So end of the day, percentage is important, but you should also get an amount, a sizable amount in your hand. So to get a sizable amount, you have to put sizable amount. So if you have to invest properly, then you have to take some risk and you have to allocate some sizable amount of your salary or your whatever income you are getting into this mutual funds, SIPs, so that you beat inflation, you beat FD, you beat all fixed return incomes, and you have a compounded effect and help you in the wealth generation journey. As I have already done a video on mutual fund, the myths related to mutual fund and how to select a mutual fund in the earlier session, you can consider going there and watching that. And also in the upcoming video, I'm going to stream a session wherein I'll be explaining with the figures on the screen how you can offset the EMI for the loan taken for your home loan just like that by going with a simple mutual fund SIP. So hope this session was really useful for you. See you in the next session. Till then, happy investing.